isn't going up anymore. So welcome to this panel on navigating data challenges and common pitfalls with ML and AI applications. I'm joined by a very knowledgeable panel of Max, Melissa, Brandon, and Peng. And the key focus for this session is on things like identifying at what point human intervention is necessary and avoiding building models on spurious relationships. My name is Ben Steiner. I'm with BNP Paribas Asset Management, and I spent my career in the application of machine learning and model risk management at investment firms in London and New York. And now I'm in the global fixed income division of BNP, where we focus on delivering long-term sustainable returns for our clients. So the first question that I want to kick off with to our panel is, as we do our introductions, please, as you introduce yourself, give an indication of the domain that you work in and that you'll be commenting on. So things like which asset classes you work with, what granularity of data, the time horizon of any signals, or the holding period of any investments, and the types of models that you're working with. So maybe if I can turn to Max first for an introduction of what you do and the types of models that you work with. Max.
Thanks, Ben. I'm co-head of forecasts at Quoniam Asset Management. Quoniam is a German quant boutique managing around 30 billion USD in equities and corporate bonds. And in the forecast team, we develop the alpha and the risk models for managing these portfolios. We tend to hold our positions for at least a couple, maybe in certain cases, not for a couple of months, but typically for a couple of months or a little bit longer. So the signals we are looking into tend to be mid to low frequency, I would say. So it's definitely not short-term trading. And personally, I joined the industry about 10 years ago, have been working in quant research ever since. And before that, I did a PhD in mathematics.
Thank you, Max, and welcome. And maybe now if I can turn to Peng. Peng, can I ask you the same question? The background, types of models, types of asset classes, and so on. Peng.
Hi, yeah, sure. This is Peng Cheng with JPMorgan. I'm with the JPMorgan Investment Bank, global research. So what we do in our team is we work with our clients, which are asset managers and hedge funds, and help them with, incorporating machine learning and alternative data into their existing investment process. Now, of course, being on the sell side, our focus is a bit broader, so we look across asset classes. But inevitably, due to the nature of these asset classes, generally speaking, we deal mostly with things like equities, FX, or volatility products. And in terms of frequency, again, we don't deal with ultra high frequency stuff, but I would say anything from daily to weekly or monthly holding periods, are some of the strategies we cover.
Great, thanks a lot. And then next up, Melissa. Melissa, if I could ask you the same, types of models, types of work, types of holding periods. Melissa.
Sure. I'm a financial economics by training. So I have a PhD in finance. And I start working on machine learning applications since I joined the automatic intelligent investing team at NN Investment Partners. So my experience with machine learning applications have been in the area of researching persistent source of alpha for systematic equity and investment grade bond funds. So the opinions I'm going to share today will be from the perspective of low frequency, long horizon asset managers. So a bit similar to Max. And I want to emphasize this because I can imagine that the challenges and opportunities that the high frequency trading firms, hedge funds, market makers could be very different from the challenging opportunities that we are facing.
Yeah, thanks. We want to get into some of the time horizon issues, certainly through this panel. And then last but not least, Brandon, same question for you in terms of the asset classes and time horizons.
Sure. So I'm Brandon. I work at OP Trust, which is a Canadian pension fund. I specifically work in the multi-strategy investing group, and I lead the machine learning efforts internally. I am asset class agnostic as long as it's the public markets, and mostly time horizon agnostic, although most models tend to be medium term frequency. And the specific types of models I focus on is research in Bayesian deep learning and model adaptability, with a sub-focus on reinforcement learning and sequence prediction.
Great, thank you very much. So that's everyone's introduction. So the first real question I want to ask is really going to drill into some of the challenges of machine learning and AI that we find in investing. Obviously, investing isn't the same as lots of other areas. I had lots of speakers today and panels today talking about the challenges of finance vis-a-vis other areas. But let's talk specifically, and Melissa, maybe I'll turn to you first. Specifically, what are the challenges of ML and AI in finance and investing that drives us towards these spurious correlations?
Right. So I think investing and return prediction in particular face a challenging set of conditions. They are very different from other domains where machine learning has more success. So first of all, of course, the small data issue is of particular concern in longer horizon investing. And if we think about stocks, there might be maximum 4,000 to 5,000 investable stocks. And moreover, we all know that financial time series are often non-stationary, and return predictions has low signal to noise ratio. But what is the most challenging, in my opinion, is that return prediction is what people call reflexive. So what it means is that the action of making a prediction will change the outcome in the real world. So given all these challenges, I think it's important to think about what machine can learn best in investing, and what do we try to predict? What is our benchmark baseline strategy? So to answer all these questions is not that trivial. In my opinion, I think having an anti-empirical view or economic theory could help us to reduce the risk of creating the spurious relationship when building machine learning applications.
Great, thanks. Yeah, just to reinforce some of the comments you made, the idea of the small data is a big one. And maybe I'll turn to Max to comment as a segue off that.
Yeah, maybe I can just add a little bit to this, because I mean, you really have to think about how many independent observations do I have, right? And in our, at least in Melissa's and our setting, even if you have 5,000 stocks, those stocks are probably driven by, let's say, max a couple of dozen factors, maybe much less. So the cross section of stocks is actually not as broad as it might seem in terms of how many observations you have, right? So, and I mean, and then you have this classical problem of measuring returns is much harder than measuring variability. So in one instance, you can cut down your time horizon into many subsegments and get more information. But if you're predicting returns, that doesn't really help. So maybe those two aspects are important as well.
Yeah, absolutely. So there's the small data issue, which is then sort of compounded by lots of other facts. Lots of people talk about the non-static nature of financial markets. Some people call it non-stationary, some people call it concept drift, some call it non-ergodic. But the idea that the system is evolving over time is definitely one of the challenges. The low signal to noise ratio we mentioned, and then Melissa mentioned this feedback loop that exists between participants, what the participants do on the system. I think George Soros called it reflexivity several years back. He popularized it, but may not have invented that. So given those are the challenges, let's talk about what we can do about them and when we should do something about them. So maybe, Max, I'll turn to you to kick us off on this as well. But what do we think about sort of auto ML, or what do you think about auto ML and feature engineering? And sort of what role does that play in the investment process in your world?
Yeah, I mean, that's a topic that's, I think, coming up more and more in recent years. And you have a lot of vendors with interesting solutions, and it really depends on the problem at hand, I would say. So if we are talking about more low frequency return prediction, I'm kind of skeptical. I mean, the problem is just you adding model complexity here. and you have to estimate even more, kind of just using the data, right? And another problem that we haven't really talked about is that in financial data, it takes a long time to get new data, right? That's also very different from, let's say, Amazon, that is just doing some experience on their website, and they can very quickly generate a relevant amount of data. But we can't really do that. In investing, we really have to wait until time passes, and only then we get new data. So we have this problem of adaptivity, or it's an adaptive learning process where people are, I mean, that's not even just machine learning problem. It's a general problem in quant research. You have this data set, and then you go over it, and then you find get some ideas, and then you fine tune it. And so it's even multiple testing corrections are not really accounting for that, right? So that's a very hard problem. And in that sense, in my experience regarding return prediction, these issues are kind of too strong to make AutoML really successful. But I think in other applications where you try to predict something else than future returns, these techniques can really do a lot of work for you and really make you faster. So it really depends on the application.
Great. Yeah, absolutely. So it's very sort of the answer is it depends, but maybe I can turn to Peng as the next one, sort of to give us an overview of what he's seeing sort of from the client side, which is, are there certain types of clients or asset classes or time horizons where people are getting enthusiastic about AutoML?
Yeah, I think the premise of AutoML is, let's say a horse race between models is that you have to hold all the other variables constant, right? And what's the most important kind of degree of freedom is, okay, how many exogenous variables entering into your model. So let's say for longer horizon, 3 months, 6 months, a year ahead forecasts, whether it's returns, whether it's volatility or other risk parameters. There are just too many degrees of freedom for AutoML to work well, at least based on my experience, and I agree with Max on that. But once you kind of reduce the horizon, let's say we've worked on, let's say, tick level data, not really, again, not to kind of forecast the next millisecond what's the return going to be, but just aggregate them and make relatively short term, let's say, day ahead forecasts, let's say on volatility, for example. Okay, I think that's a very good example of where AutoML can come into play, forecasting short-term volatility using intraday, realized data. So let me give you an example of what's the most well-known volatility forecasting model. It would be the GARCH, right? But it uses end-of-the-day data to forecast day-ahead return. But let's say, given the intraday data, right, we can actually improve on it quite a lot by taking advantage of just the short-term memory clustering property of volatility. And, if you know a little bit about GARCH, basically it's one process that's exponentially decaying, right? But we find that for, let's say, equity volatility, they're actually, the information decay is not necessarily exponential. It's actually much, much slower. So, given that we have intraday data, which is very rich, right? And we kind of know that, okay, let's say if I just forecast 1 day ahead volatility, there's really not that much other information that will make a difference. So, we only need to limit ourselves to the existing intraday volatility. We can actually play around a lot with the model choice, right? It could be just GARCH with, one decaying process. It could be multiple decaying, exponentially decaying processes, or it could be something akin to a long short-term memory neural network, for example. So, we can actually experiment with a lot of different models and find which one is the most effective. So I think that's kind of, a good example, right, or a positive kind of evidence for where AutoML could work for investors.
Great, thanks. So the sort of the it depends answer definitely seems to have a value in the short term, near term forecasting horizons. And maybe I'll turn to Melissa next to get her view on longer term horizons. Is there a role for AutoML or automated feature engineering, or some people have called it try everything under the sun, throw every model against the wall and see which one sticks. Do you see a value for that in your sorts of time horizons, Melissa?
Yeah, so in my experience, I'm a little bit more echo Mac's opinions. So I have been very hesitant to use AutoML or automatic future engineering tools when building machine learning models for long horizon investing. First of all, I think in order to learn through experience, right, the machine needs a representation of what it's trying to learn, and which requires research choices. And like any scientific activities, that the research questions we ask and the information inputs we look at matter as much, if not more than, the models we use. And I think we are nowhere near creating an artificial general intelligence. And I don't see that AutoML tools are being able to ask insightful questions anytime soon. And the way I approach machine learning applications would be to start with an investment thesis derived from an economic theory or observations. And for example, one of our investment theses is that the wisdom of the clouds, or in a more theoretical term, we can also call it investor beliefs. We believe they are crucial in asset price. And certain clouds beliefs could be more predictive than others. And then we can use machine learning techniques to help us to extract these beliefs or wisdoms. So by, for example, constructing process from natural language processing of social media or news. We have some initial success in this area, and the whole process involves so many research choices that I don't think existing AutoML tools are able to make at this moment.
Great, thanks. So it sounds like sort of at your time horizons, the economic underpinnings or the economical theory for why things are happening is still important, and just data crunching isn't going to reveal those perhaps at certain time horizons. So the next topic I want to hit on is so this idea about human intervention. I guess there's two schools of thought, one of which is that the model will do everything and the humans don't intervene, versus the idea that the models are a tool, the human is observing them, and the human is going to keep watching them. So I want to turn to Brandon next to discuss the idea about sort of if human intervention is necessary, and if it is, then at what point is human intervention necessary? Brandon.
Sure. So first, I'll say I don't think humans should intervene in a strategy regularly because you can't backtest that. So that's the first thing I want to say. But I do think that human intervention is necessary at times when the strategy is breaking down. And essentially you have to make the decision whether to shut down the strategy or not. And so I'll kind of walk through a few ways that I think of how to actually identify this. I'm going to start with one that I think is a bit suboptimal, but I think it could be still useful. And then I'll talk about what I think is more useful. So the first one is, well, both of them come down to understanding the probability distributions, right? Or at least the return distributions of your strategy. So let's say you build a strategy, you have some back test, you can get some return distribution from that back test. And you can now monitor how it performs live. And you can compare the live performance, the return distribution, to the backtest return distribution. And if they're materially different, then you can say, okay, I don't think the strategy is performing how I thought it would perform in the backtest, therefore time to shut it down. Now, there are a few nuances here. One could be that, well, live performance, there's a different regime. And so you're not taking into account the fact that the regime has shifted. And so you wouldn't expect the strategy to perform as it would in the backtest because they're two different regimes. And so one approach you can do is split up the backtest into various regimes using some clustering algorithm or something like that. And then try and identify which regime you're in and try and match those return distributions and see if they're materially different. Now, this also poses a problem because regimes are ever evolving. And so I don't think you'll ever truly experience the exact same regime that you have in the backtest. So those are a few problems, but I think some people could still use this to a certain extent. And then to actually compare the return distributions, you can use something like a KS test to see if they're equivalent, or you can use like KL divergence to say, okay, they diverged like they have a KL divergence of 2. That's my heuristic for checking on the strategy, make a determination of if it's working as I think it should. If not, shut it down. So that's kind of like one approach you can use to identify at what point to intervene. The other approach, which is more in line with the work I do, is estimating uncertainty. And so I previously did a session on uncertainty, and I didn't touch on this specific topic, but there's this concept of aleatoric uncertainty, which is essentially like your estimated noise in the target variable. Like, just think about it like that. That's the simplified version. Like, there's some irreducible uncertainty, and so that's basically what you're estimating. So no matter how good your model is, it won't be able to reduce it noise that much more because the markets are just noisy. And so if you're able to estimate this, and you're also able to track your prediction error over time, so it's kind of like the ex ante ex post, what your prediction error should be, and you can compare that. And over time, if your ex post, like your measurement of prediction error, it's way exceeding your estimated prediction error, then you're like, okay, this model is not good at estimating uncertainty. And uncertainty is actually easier to estimate than return prediction. So if it can't estimate that well, I have no confidence in estimate the return prediction. So I should definitely shut it down because the strategy is not performing as it should. So that's kind of a high level of different approaches you can take to check on the strategy in real time to see if it's performing as you think it should. If it isn't, let's intervene. So I guess I was rambling for a bit, but I'll pause here for a second.
Thanks. That's very interesting. The language of the different sources of uncertainty actually was very similar. Back in the day when I was in school, I learned about process risk and parameter risk. Obviously, yes. different names for a similar thing. The process risk is the inherent uncertainty in the structure of a process, and the parameter risk might be, the estimation of a certain parameter. And I think you're describing what I would call the process risk, the aleatoric uncertainty.
Yeah, exactly. Yeah.
Great, thanks. One question that occurred to me that maybe I'll pick on Peng as the next one because he's on the sell side and he's supposed to be good at answering questions on the fly, is if a client says, well, I like the idea of what Brandon just has commented on, but this idea about comparing two distributions, the in-sampled or the backtest distribution versus the live distribution, and when they're sufficiently different, it's time to stop. Obviously, if I was a client, I might say something along the lines of, but that's all well and good, but by the time my live distribution is sufficiently different from my backtest distribution, I've already lost a lot of money. I've got to collect a lot of data. And the problem with collecting data on bad strategies in real time is that they're losses rather than profits, that they're losing money. So if a client said that to you, Peng, or if someone on the buy side said that to you, sort of what other advice would you give to them about sort of human intervention, or at what point should a model receive some kind of human discretionary overlay?
Yeah, I think maybe similar to what Brandon said. I think for me, a lot of times it's about risk management as well. Like, obviously, when you implement a model, ideally the distribution shouldn't be very different, and it shouldn't be like very volatile. But if that's what happens, then a lot of times I think you need to consider whether you need to basically apply some kind of shrinkage to your model, okay, to rein it in. I don't necessarily think that you have to wait for 3 months or whatever it is to say, okay, here's my realized distribution and it differs significantly. But you can probably do it the other way around. You can say, let me start with a model that I have confidence in, that I know relatively well, but I'll give it a little bit more, let's say, tilting, right? Some kind of, let's say, factor tilting or whatever degree of freedom, so that it's allowed to deviate a little bit from my kind of traditional model. And if it does well, then okay, I can increase my let's say allocation or my degree of allocation towards this new model, okay, and to allow it to keep increasing kind of its weight in my portfolio. If not, I will do the opposite. But at no point in time should you just be like, okay, you know what, like I will go all into this new strategy, and 3 months down the line, I find out that it doesn't work, and I have to go back to whatever was before. More so, I would say probably a bit of a controlled approach in the beginning, and slowly let it grow. So that would be my advice. I don't know if that makes sense.
Yeah, absolutely. An incremental approach. It's not a binary all or nothing. Max, do you want to segue off that comment?
I wanted to add that it's not, I mean, in some cases, it's not really necessary or maybe feasible to wait to let it play out, so to speak. And depending on your model, you might see things earlier if you just, I mean, at least if the model is not too complex, you can do from the interpretable machine learning literature as well, right? So you can try to understand what is actually happening and is something, so if there's a shock in the market, right? And I have a model that's predicting return or risk or something like that. It's pretty clear that if it's a large shock, like in last March, for example, the model will be sensitive to this and might adapt quite quickly because it's just such a large shock in the Y variable, right? So it depends, I mean, obviously how you estimate. So if you make it more robust, it will be less of a shock. But you should certainly look into your model after something more extreme is happening and try to understand if the relationships that, especially if you put some economic thought or some regularization in your model to keep it into certain boundaries that make sense to you, if that's still the case, right? Or something has changed within the model and then you don't have to wait to let it play out. If you see something there that's not according to your theory or not within certain boundaries of your beliefs, so to speak.
Absolutely, absolutely. So the point being, we don't have to wait for a full distribution to evolve. We can get certain statistics long before a full distribution.
Yeah, we can look at the model fit, so to speak. Is it rapidly changing? Is there a big jump in? I mean, it really depends on the model, right? I mean, very complex models, the more complex the model, the harder it gets to really understand the relationships within the model.
Brandon, I'll turn it back to you for additional comment.
Just one comment I want to make. So I have like mixed feelings on interpretable AI, especially in the context of financial markets. Obviously, I get it from like a decision maker's perspective, like they want to know what's driving these things if it's managing money. But I've also seen that it can be used in a bad way because, well, the whole reason why you're using a lot of these algorithms is to get some insights that you don't have, right? And then if you have this decision maker on top that's imposing their own bias on the model that says, I don't agree with that economic rationale, therefore we're not going to make that trade. Then it gets a bit iffy to me, and it begs the question, why are you even using it in the first place? I just wanted to add that point.
Completely agree, and I'll just sort of, I guess, put my own personal view on that. Then do we view the ML and the AI as giving us the cause of the underlying drivers, or do we view it as almost a calibration technique to sort of calibrate a model that's been predefined? Okay, let's move on, which is a nice segue into, given that we all agree that financial markets evolve and that sort of what's driving the markets for the last 30 years might be slightly different for the next 30 years, or what was driving them for the last 12 months might be slightly different for the next 12 months. So there's this concept of evolution in the markets. Can machine learning techniques, or which machine learning techniques can help us get a handle around so this concept of the markets evolving? Maybe Max, I'll turn to you first in terms of how do you anticipate the evolution of markets? Max.
That's a really hard one. I mean, if I really knew this answer, right, I probably would have my own hedge fund and not talking to you guys, just doing sitting in my cave and making money.
Or more around recalibration. Maybe let's say recalibration. Let's talk about when do you recalibrate models, and is the answer to recalibrate models, or is there any assistance that certain machine learning techniques can help us with? And maybe phone a friend. We'll bump over to Peng if this was one of these quiz shows. Peng.
Yeah, I think Brandon touched on it, I think very well, which is a lot of times markets are in different regimes. So I find that, of course, history doesn't repeat itself, but it does rhyme. So I find that what are the most kind of indicative state variables, right? Like interest rate is one, the level of interest rate, the rising and falling interest rate. So just see what happened in the market in the last couple of weeks. I think, that could be a very good state variable for regime identification. Another one is volatility, whether we're in a high volatility regime or low volatility regime. So, those are the kind of things that, and we do observe it, and there's plenty of academic and practical literature that shows that, okay, like strategies behave one way in one regime and behave totally differently in another regime. So when designing these models, one can take it into consideration so that, right, obviously, the model that you utilize now with VIX at 20 is different from when VIX is at 80 and when VIX was at 10. So that's kind of like what you can, I think, incorporate into your machine learning model.
Okay, so more of a regime awareness. Brandon, I'll turn it over to you now as well.
Yeah, so I love talking about this. Is actually my main area of research is model adaptability. So if you remember to what I was previously describing as to when to detect breaking points in the system, you can actually use that as a means to have an adaptive model, right? Like if your model can self-identify when it's not working and then recalibrate the model to what it feels is the new regime, that's basically one part of the way to the solution. Now, I can't really talk about too much of the details, but that's at a high level how I sort of think about this. And one other point I'll say, although the models are constantly changing, one thing that's not changing is the fact that it's basically a social science, right? It's the interactions of all these agents that are determining the price. So that aspect is not changing. That's just how the market is set up. And so if you can come up with a way to model the agents directly, and if you can figure out which agents are in the market and at what size at any particular time, I think that you have a model that's a lot more robust to various regime changes.
Okay, thank you. Good, that's good. But let's flip that around then. So there's sort of ML trying to solve evolving markets, but the markets themselves are evolving to use more ML. There's more and more people using data-driven approaches. There's more and more people doing systematic investing. This is the reflexivity that Melissa described at the beginning in action, which is the participants themselves might be changing the nature of the markets. Can I turn to perhaps Peng again with your knowledge of what's going on the sell side, which perhaps to comment on sort of how the evolution of the financial markets has changed as more and more people are using systematic approaches or ML approaches?
Yeah, absolutely. So a very good example is recently the involvement of retail participation in the market, right? Like actually in the academic literature, we have known this, behavior of retail investors very well. It goes back to behavioral finance, 20 to 30 years. But the problem is historically, people have never had the opportunity to get the data to implement trading strategies because most of the retail brokers or none of the retail brokers are willing to make this data available publicly. They only make it available to, academic researchers for research purposes. Okay, so even though we know their behavior and there is some kind of signal behind their actions, we're not able or nobody is able to create trading strategies. But recently that has changed, right? I mean, as we all know, you can basically scrape data on Reddit, on Twitter, et cetera, to measure their intention. Okay, so I emphasize that these metrics that you have gotten from social media, they're intentions. Okay, and then on the other hand, there's also possibility to look at the actual actions, which is based on the order flow information, which is also recent academic results as well, based on public data. So generally speaking, when we look at these two, what's their relationship? Intentions tend to lead actions by, let's say, 1 or 2 days, right? Like let's say someone posts something on Twitter or Reddit. Okay, people read it, think about it, maybe place orders in a day or two. But very, very recently, what we found is that there is evidence. Now, I wouldn't say like I've quantified it, quite rigorously, but it seems like hedge funds are now very actively mining for data on these social media, and now price reaction follows very, very fast from just social media indicators, not with 1 or 2 day lag, but sometimes within minutes or hours. So that kind of tells us that okay, maybe the signal has changed from being from intention to action led by the retail users to intention to retail, to hedge fund algo, front running retail users. So that has changed the market behavior, I think, which is kind of an interesting thing. Now, again, we haven't done any rigorous research on it, but I think that's from anecdotal evidence seems to be what's happening.
Absolutely. I mean, thank you for highlighting that. It's sort of the nature that the data set itself that might have been a very rich source of predictive value is now becoming less valuable, or at any rate is becoming the time decay in there is getting shorter and shorter. We'll go on to one more question now, talking about use cases for machine learning. But just a reminder to the audience, if you have any questions for our panel, please do carry on posting them, and we'll go to audience questions just after this question. So this next question is around use cases for machine learning. Obviously, we're sort of all focusing on the holy grail, or the goal of return forecasting. Can we use machine learning for return forecasting? So I'm curious to hear from you, and maybe I'll turn to you first, Max, about the return forecasting side, but also any other elements where machine learning can be used, because there's obviously a number of different activities that go on in investing and not just return forecasting. So Max, use cases for machine learning.
Yeah, maybe I just name 3 things that I find interesting, and then we can see what the audience really wants to know in detail. So something that I find interesting, it's still as an alpha signal, is valuation. So for example, at our company, we have a long history of trying to quantify what is the fair price of a corporate bond. And I see a lot of potential there for machine learning to do that better. Something else would be liquidity forecasting. That's already going more towards automation of the process, right? So if you're a global investor and you invest in all kinds of markets, it's just hard to really know all the seasonalities of liquidity, all the trading calendars, but also some other effects in liquidity. And I think that's an interesting space to use machine learning to tell the optimizer basically how is liquidity going to be over the next couple of days, depending on how long it takes you to invest your portfolio. But for us, it would be probably a couple of days up to maybe 2 weeks or something like that. So for it's interesting to know, even in the more obscure pockets of the market that our local traders don't know as well, what's a good prediction for liquidity. And finally, maybe even going further from investing, it's just data quality management. So I find it interesting to use machine learning to identify patterns that tell us something might be wrong with data that is coming in. I mean, as once we just have all these large amount of data coming from different sources each day, and it's hard to look at everything manually or with very simple models, right? So if there are a bit more dependencies, so some data set might actually tell you in conjunction with another data set that something is wrong, and both on their own might seem fine, right? But
yep, absolutely. So the valuation, the liquidity, and the data quality management, sort of there's lots of potential uses outside the core focus on return forecasting. Maybe I'll turn to Brandon now. And do you want to say a few words on other potential uses of ML, again, outside return forecasting, that could be useful?
Sure. So yeah, I think I mentioned a few times, I focus a lot on probabilistic modeling. And so with that, you can extract some metric of uncertainty. And what I found is that you can add value a lot more easily through risk management via uncertainty than you can through return forecasting, or at least in my case, that's been the case, that using machine learning for risk management portfolio construction has yielded a lot better results than specifically for the signal generation portion of the investment pipeline.
Thanks. Yeah, so forecasting the risk forecast rather than the return forecast. Thanks.
Yeah, exactly.
Great. So let me turn to some of the audience questions. There's a question from Long. For mid to long-term prediction, so this is going to be for either Max or Melissa, How would one determine what frequency of data should be used to train the model? So determining frequency and length of data. For example, if fundamental data is every quarter, how could it be combined with monthly or even daily data? So the question is around how much data should we use? What frequency of data should we use? And how do you combine time series of irregular frequency? Maybe Max, I'll turn to you first, and then Melissa for any additional comments.
Maybe first, in general, I would still be interested in frequent data. So even if my prediction horizon is long, right? So if there's a new information coming very rapidly, I definitely don't want to wait until I have this prediction, this information in my model. So I think it's fine to use daily data if you make predictions over the next year. You definitely should do that. And I mean, yeah, there are some techniques to work with overlapping data. And I mean, if you want to do statistics, but that's not really machine learning, then you have all kinds of problems with overlapping data. I would say maybe in machine learning can even be a way to help you in that space. Yeah, I mean, from the statistical literature, there are also some mixed frequency models. I don't know if Melissa has something to add, how that can be combined specifically with machine learning. I don't really have a specific comment on that.
Yeah, so if the colleague that has the question, that what he or she have in mind is to using machine learning model to on the transitional set information that we often use in predicting return, then I do not think this machine learning actually add much value there, because I have experience of using like neural net or deep learning models directly using the standard inputs we use, like for example, like fundamental variables from balance sheet or income statements, and just using a more complex model doesn't really outperform a simple linear model, at least in my experience looking at monthly return predictions. And what I do find that is interesting, and also maybe equally to what Max pointed out, is to use machine learning model to extract more high frequency information that actually sort of predicted the fundamental values, which we can use as the input to predict return. For example, we think about revenue growth. Now, for some companies, contemporaneous revenue growth is highly correlated with return. So if we can use high frequency data to predict revenue growth, so basically we use machine learning to create inputs, and this fundamental value is not reflexive, which means that you cannot really react and change the prediction will not change the power of the predicting value of the model. So yeah, that's kind of my opinions on that. Not sure that's answer the questions.
Great, thanks. The next audience question will go to Gustavo. Now, Gustavo asked two separate questions, which are both great, but I'm actually going to pick the second one. And I think I'm going to ask this to all of you to see what your opinions are, because I'm curious. It's about synthetic data, so simulated data. So the question is, what are your thoughts on using deep learning, but I'll expand it to any learning. So what are your thoughts on using synthetic market data for enhancing the testing or fitting of models? Brandon's raising his hand, so I'll pick on Brandon first, but I'm curious sort of if others have the opinion. Synthetic data, good or bad, useful or not useful? Brandon.
Sure. This is extremely topical because we are using synthetic data currently in our testing process. And the reason is because we have a very small number of time steps historically, if you think about it. And if we're analyzing a strategy over that time horizon, we better be like really like convincing it. And I mentioned before, I do a lot of work in model adaptability. So I want to see if my model is able to adapt to all types of regimes, right? Stuff that we haven't even seen before, but it should embed some realistic characteristics of historical price series that we've seen, right? But we want to produce all these different types of time series. A specific method I use is denoising autoencoder with style transfer. But I think it's very important to see how does your model perform in all these different regimes. Now, there's a nuance there in that if your model also takes into account economic data or news or something like that, you can't do this that easily because you have to have something that's able to realistically generate all these complex relationships. And I personally haven't been able to, maybe someone can. So this is only applicable to models that rely on price action data and features that can be derived from price action.
And to clarify, are you using the synthetic data to test a model you've already developed, or are you using synthetic data to develop the model?
Great question. The former. I am still working on incorporating the latter. It's a lot more difficult than it sounds. It's really, really tough to do properly because there is this concept of like you want the model to adapt to the current regime. And if you expose it to all these other regimes, it's not really learning the newest regime that well, right? It's generalizing at the expense of accuracy. So it's a really hard trade-off to make.
I would echo that. And I'd also say that if you are able to make a synthetic simulator that's good enough to reflect the real world, your work might be done. And any deep learning or reinforcement learning that might learn off that model is secondary. So having a good enough model is, I think, the challenge in my opinion. I did promise to ask everyone a question to end with. I wasn't use that, but instead I'm going to ask a quick fire question to you all. We're coming to the end of the panel. Thank you all for the questions from the audience, but just one quick fire round, maybe 30 seconds or a minute for each of you, which is what is one thing that you wish you could have told your younger self about modeling or about ML? So if you had the opportunity to go back in time, let's say 5 years, and teach yourself a lesson that you would have learned over the last 5 years, what would it be? Maybe Melissa, if I can turn to you first. What's the one thing that you wish you would have known 5 years ago?
Well, I think when I started applying machine learning techniques, I was so excited about all the new techniques that are coming up, and I got carried away in wanting to learn and try out as many machine learning tools as possible. In some sense, I put aside my knowledge in my experience in financial economics. But over the years, when I get more experience, I actually realized that financial machine learning is really a modern quant who use data science tools to process financial information and to understand market participants' behaviors. And there's no need to spend all your time trying to master every single machine learning algorithms that are available. And I think understanding the fundamentals and understand how market works and how market participants behave would actually save you more time and perhaps more fruitful in the long run.
Great, that's a good one. Max, if I can turn to you now, the same question.
Yeah, I mean, I can wholeheartedly agree, of course, with Melissa. Maybe to add something as well, what I found very useful is the literature on, for example, the reusable holdout paper. So some ideas about how you can, I mean, given that we have this fixed amount of data almost on every project, and we cannot generate new data, how do we deal with testing our predictions, right? So I mean, if you've used the test set, is it already game over? And can you really only do it once, or is there something that can help you to learn a little bit, but not too much, right? So and that's why I find this literature really interesting. And the basic idea is just that you want to break, or you want to slow down the circle of adaptivity. So don't analyze so after your first model, don't analyze everything on the test set in great detail, all the factors, what happened exactly, because you will actually speed up this adaptivity, and this just leads to overfitting, and then you don't have any new test data. So I think that's really important to be modest, because you will need a couple of iterations on the test set probably, because you have some new ideas, and then they only come, unfortunately, after you made the first evaluation. So don't be too greedy with your evaluations of the test set.
Yeah, absolutely, absolutely. And then moving to Brandon for the same question, what advice would you wish you'd given your even younger self?
Sure. I'll keep it short. The first thing is don't get upset when things don't work out, because 99% of them won't be good models. And the other thing is focus on things that other people aren't focusing on. I think those are the two biggest things.
Great. Both very good ones. And last but not least, Peng, any thoughts from you?
Yeah, I think, let's say 5 years ago, I was a big believer that if you torture the data long enough, nature will confess. But I think, over this period, I've found that, it doesn't matter how good your model is, how well designed it is, doesn't override the quality of your data. So, if you get the good data, the right set of data, like it will just work out beautifully, even if you just apply linear model to it. So like nonlinear models, machine learning models can extract extra information compared to linear models, but only by so much. So, again, I think, data quality comes number one, and then, the model is an overlay on top of that.
Great. I mean, that was 4 excellent comments. I was just frantically scribbling down, but the summary of this all was from Melissa. Don't fall for shiny new algorithm syndrome. It's not about the best algorithm or trying to learn all the algorithms. It's actually the fundamental economic behavior or the fundamental economic relationships that are there. For Max, it was this idea that data is a limited resource. Don't burn it all. Be smart about how you're using holdout periods, because if you've used your data, you've used your data. So be smart about holdout periods. From Brandon was it's called research for a reason. If we knew what we were going to find, it probably wouldn't be called research. So don't get upset when it doesn't work. It's a funnel, lots of things at the top and small number of things at the bottom, and focus on things that other people are not. Hunt where other people are not. That's very important. And last but not least, from Peng, the data is the primacy. The data comes first. The modeling technique almost comes second. I agree with all 4 fantastic takeaways. My thanks to Melissa, Max, Brandon, and Peng for this interesting, informative, educated discussion. I've certainly learned a lot, so thank you all very, very, very much.